Yeah, okay, great. Um, yes, this is a continuation class prior to the liquidity class we had. So we'll be continuing the method of liquidity. I believe after today's class, we should be done with everything that has to do with liquidity. Then we can go on into liquidity cycle and the other aspect of liquidity. So, but for a recap, we talked about liquidity being orders. We say liquidity are orders in the market. So when we mean liquidity are orders in the market, what type of orders are we talking about? We talk about our buy stop, our sell stop, our buy limits, sell limits. The four together are your pending orders. What we call our pending orders. Our pending orders. So we have our pending orders, we have our market execution, we have stop loss. Yes, so one of the class I was having, someone mentioned take profit. So we say take profit is not an orders for liquidity. So when we say liquidity, we are talking about orders in the market. We are talking about orders in the market that we place for providing liquidity in the market. So stop loss is not used for providing liquidity in the market. It's rather we use it to take out liquidity. So stop loss won't be part of our. Then we also have what we call break even. Break even, yeah. So these are the 4 ways we provide liquidity in the market. And we mentioned that liquidity are on every highs and lows in the market. Every highs and low in the market, that's where you have a liquidity. So every highs and low here is where we have our liquidity in the market. So we say there's money resting here. There's liquidity in this area. There's liquidity here. There's liquidity. There's liquidity, as we all know, there's liquidity every highs and low. So we don't want to be too confused about liquidity. That's why we are now focusing on just the major liquidity areas in the market, the major liquidity points, so we can have a very proper trading plan. And those 4 liquidity areas, we mentioned them to be we mentioned those 4 liquidity areas to be we said they are the 4 liquidity areas are, we have our transactional liquidity, our transactional liquidity for correction. The second one is our structural liquidity for continuation. And the third one is our inducement liquidity. This is liquidity for expansion. These are the only 4 liquidity we need in the market. These are the only 4 liquidity we need in the market. These are the only 4 liquidity we actually need in the market. So our transactional liquidity, responsible for correction. So when I say liquidity is responsible for correction, what am I talking about? It means on every market scenario, you have push such as this in the market. So this, you need to understand that this, in every push in the market, when you have higher high, higher low, higher high, higher low, okay, these are all transactions in the market. These are all transactions, as we mentioned, 1 transaction, 2 transactions, 3 transactions, 4, 5. These are transactions. So they have to be transaction. There have to be liquidity for each of these transactions to be able to play out. So when we say which liquidity is responsible for this transaction 2 year, this transaction 2 year is what we know as transactional liquidity. For this second transaction to be able to play out here is what we call our transactional liquidity. For this transaction to be able to be carried out, transactional liquidity has to be taken out. For this transaction to be carried out, a transactional liquidity is has to be taken out. So a transactional liquidity is responsible for correction. Every correction you see in the market, there have to be a transactional liquidity responsible for that. So when you have this is being taken, when this I is taken out, or when this I is taken out, you are expecting a correction in the market. That correction you are expecting gets the transactional liquidity has to be provided for that correction to be able to carry it out. The same thing happens to here. When another transactional liquidity is taken, you are expecting a correction to be carried out in the market. A correction to be carried out. So when you understand the phase you are, when we get to liquidity cycle, you're going to understand the phase we are in the liquidity. So when you know you are having a transactional liquidity, you are expecting a correctional phase, which means a transactional liquidity has to be taken. And when a transactional liquidity is taken, you are expecting a correction. And what are you looking for after you're having a correction? Then you can now expect your MSU or your EPA, another time frame to carry out. So for instance, if we say this is a 4 hours chart, you have a 4 hours chart here, and you have a transactional liquidity taken from the 4 hour. From this 4 hour, you have a transactional liquidity taken from your 4 hour points. So 4 hour, the transactionality has been taken on a lower time frame, such as 15 minutes or 5 minutes. You can expect what? An EPA from this angle, from this area. When you get an EPA correction to the downside and followed by an MSU on your lower time frame, such as 5 minutes or 1 minute, then you can take a very good successful trade from this transactional liquidity to the next EPA. Hope I'm communicating. So this is the idea of transactional liquidity. So let's go to structural liquidity, because these are all we have talked about in the previous class. So, but we're going to be, you can ask your question, although. So structural liquidity has to do with, structural liquidity is the liquidity where we say is the last high before the main. In an uptrend, is the last high before the main high, isn't it? So it's liquidity. Say last high before the main high on an uptrend. then on a downtrend, last low before the main low. So a structural liquidity is actually a liquidity of that's so when you have a structure like this, there's always a last in this is an uptrend, because you always need to focus on the trend whenever you are trading. Focus on your trade first before any other thing. Okay, so this is an uptrend. Then for you to understand your structural liquidity, you need to understand the last low before the main, low before the main low. So this is the main low here on this market. You can see this is the main low here. But where is the last low before the main low? This is it. So this is our structural liquidity. This is our structural liquidity. This liquidity is responsible for continuation. That means when price come down to take this liquidity, price continue upward. Continuation to the upside. This is the last liquidity where we get most of our liquidity trade. Okay, so it's important. On our previous class, I explained what makes price actually come to this liquidity. So I won't be saying that here. Maybe from the record you can try to understand that why price usually come to this liquidity. But you need to understand, okay, this is a liquidity for continuation. Same thing on a downtrend. If you're on a downtrend, this is our liquidity. This is our liquidity, structural liquidity. The last high before the main high on a downtrend. Very, very key liquidity to pay attention to. So when you have a liquidity like this on lower time frame, on lower time frame, you can have, on this trend alone, you can have another liquidity here. You can have lower time frame, you can have this kind of structures on another time frame. Let's say this is a 4-hour time frame. 5 minutes or 1 hour, 15 minutes, you can have this other structure. You can see that inside this push or transaction, you still have another transactional liquidity inside it. Inside this push, you still have your own transactional liquidity inside it. Inside this push to the upside from internal structure, because this is now like an external structure. This black line is not like an external structure, higher time frame, like 4 hour. Then the red line is now like a 15-minute time frame, the lower. So inside the push, you still have, as an internal structure, you still have your liquidity last low before the main low. The same thing to here. Inside this, as much as you have your major structural point here, you still have structural liquidity in this push. You still have structural liquidity in this push. So that's the idea of structural liquidity. And overall, as a whole, you still have your structural liquidity here. So let's look at what we are actually doing today is inducement liquidity. So inducement liquidity So when you are in an uptrend and you have higher high, when you are in an uptrend and you have your higher high, higher low, higher high, higher low, higher high. Okay, let me just use this first. You have your higher high, higher low. Inducement liquidity is always sitting in the new higher low being created in the market. Inducement liquidity is sitting on the new higher low Remember, I'm on uptrend. I usually give uptrend examples. So it's always sitting on the new higher low. So if you are in a downtrend, it will be sitting on the lower high. But in this scenario, we are in uptrend. It's sitting on the new lower higher low here. So whenever you have a push to the upside, check your new higher low. You should be able to find your liquidity here, your inducement liquidity. So if price comes here and then goes up again, if price comes here and then goes up, it means the inducement liquidity has goes up from this place now to this place. Here we now have our new inducement liquidity. So it means our inducement liquidity is no longer here. The inducement liquidity is now here. It is always sitting on our new higher low. Did we have liquidity here? Yes, of course, we have liquidity here. But the inducement liquidity is now here. Hence, the liquidity here is the last low before the main low, which is our structural liquidity. You can see how these things are working together. So our previous inducement liquidity has now become structural liquidity because we have a new higher low. So if price goes further, then inducement liquidity goes higher. Our inducement liquidity will now be sitting here. This is our new inducement liquidity. It is always the new higher low in an uptrend created in the market. So looking at this market, what is here in this middle? So there's something here in this middle.
And structural liquidity.
This is our structural liquidity here. We have our structural liquidity here, and we have our inducement liquidity here. So it means there's something in this middle. What is here in this middle? There's something here. We won't pay attention to it, even if there's liquidity there. We won't pay attention to it. The two levels to pay attention to is the inducement liquidity, which is here, sitting here, and the liquidity sitting here, which is our structural liquidity. The inducement sitting here, which is the inducement liquidity, and the liquidity sitting here, which is our structural liquidity. Those are the levels we pay attention to. Does it make sense? So I hope you guys are getting this now. Yeah. So don't ignore this. Don't ignore this. But always know that the liquidity here is not as important as the one here and the one here also. If price does this again, we now have our new inducement liquidity sitting here, right? So we have our liquidity sitting here. Our inducement liquidity here. There, you need to understand now that there is liquidity here and there is liquidity here. But the liquidity here and the liquidity here is not as significant as the liquidity on the structural side and this inducement liquidity. And mind you, for the structural liquidity, if the internal structure, it's actually the internal structure that determines it, the structural liquidity. So if you are looking for structural liquidity, as much as this is the bigger time frame, you can see this is your structural liquidity. But for structural liquidity in most move, it is determined by the what? The internal structure. In this push alone, it has its own what? In this push alone, it has its own structural liquidity.
Sorry for cutting you.
Yeah, I can hear you.
I still don't understand how you are choosing your inducement liquidity and structural liquidity on this drawing that you're doing.
Okay. So, do you understand transactional liquidity?
Yes, I do.
Do you understand structural liquidity?
Last low before the main low. Yes, I do.
Yes. So, do you understand that this entire structure, this is your last low before the main low for structural liquidity? Right?
Okay. Yes.
Yes. So, this is your structural liquidity on this entire structure as a whole. This is your structural liquidity because it's the what? Last low before the main low, right?
Yes.
Then for this structure here, do you know that this is your, for this structure here, this particular structure, do you know that this is your structural liquidity here? Do you agree with me?
That is on a lower time frame.
I said it is your internal structure that determines your structural liquidity.
Okay.
In every push. This is a push. Every push has its own structural liquidity. Are you getting me?
Okay.
Every push. This is a push on its own. If you classify this as a push, then where is the structural liquidity for this buy push? It is on the last low before the main low, which is here. Then, if this is a push, also, this is another push, isn't it?
Yeah.
This is another push. So, what determines the structural liquidity on this push is the internal structure. So, if you look at it, if you look at this push here, you are going to see some uptrend, downtrend, up, higher high, higher low, higher high, like internal structure in it. On this push, you are going to see last low before the main low. That area is your what? Structural liquidity. Do you get my point?
Yes, sir.
Same thing to here. This is another push. This is another push again. You have your last low before the main low. Yeah, which is what? Your structural liquidity. So for the inducement liquidity is always sitting on the previous low. So look at this market now. Where is the market currently? We are here, right? We are currently here. Where is the previous low in this market? The previous low in this market is located at this low. And that is your inducement liquidity. If price does this, from this point, it comes down and it gave us a new high that breaks this high. Where your inducement liquidity is no longer here again. Your inducement liquidity is now sitting in this new lower high. Does that answer your question?
Yes, sir.
Okay, that's good. So I now mentioned that initially here was our inducement liquidity, but it's no longer our inducement liquidity because we have a new lower high sitting here. But the fact that we have a new lower high sitting here as our inducement liquidity does not mean There's no liquidity here. There's no liquidity here. There's no liquidity.
Hello, sir. Sorry
Yeah.
for cutting you. No,
Okay,
sorry.
okay, go ahead.
See, the transactional liquidity and inducement liquidity is confusing.
Okay,
because
the transactional liquidity
and the inducement liquidity is confusing because I was told that inducement liquidity does not break structure. It will just manipulate. The comer can take up his manipulation and then touch the POI before moving. It doesn't break structure. So I don't know, this one now you're telling me that it's break structure. It's confusing me. And it's all, what I'm telling me is that it's something with transactional liquidity. According to what I said 10 minutes here now. The almost say that is similar. But this one I know doesn't break structure. Structure is already broken. You just come and induce. Then before touching the POI, induce buyers. Then come and touch the POI and then go up, control the direction. So it's confusing me now. The one you call inducement liquidity and transactional liquidity, as we explain here now. So
okay,
please throw more light on it.
Okay, let me show you this. So transactional liquidity is responsible for correction. Take note of that. Put that in your mind. Transactional liquidity is responsible for correction. So, because the reason why we are giving this a name is for you to focus on only the liquidity that matters. Only the liquidity that matters in the market, which are these three liquidity. And transactional liquidity and inducement liquidity are totally different liquidity. Just that if you don't understand the trend of the market, if you don't understand the direction of the market, you might find it difficult to identify between transactional liquidity and inducement liquidity. It will be confusing, but if you can identify the direction of the market, that okay, we are currently on an uptrend, then transactional liquidity is responsible for correction. So when I mean transactional liquidity is responsible for correction, what I mean is whenever price takes your eye, you have an uptrend, the up push, higher high, higher low. You are expecting what? What are you expecting next? You are expecting an higher high, isn't it? Of course. So you're expecting an higher high to be taken. When an higher is taken, the liquidity transaction that was taken here is what we call transactional liquidity. Because you understand that this is a push to the upside, higher high. This is transactional liquidity and not inducement liquidity. The only time you classify this as inducement liquidity is if you don't know what type of trend you are dealing with, or you are not sure you are in an uptrend. That is when you classify this as inducement liquidity. And if you say this is an inducement liquidity, then you are expecting price to further push to the downside. Because what inducement liquidity does is expansion, is not correction. That is what inducement liquidity does. So if you know this is an uptrend, you have identified that this is an uptrend, and the liquidity here has been taken out here, what you are expecting after a push to the upside, you are expecting a correction. So the transactional liquidity that was taken here is responsible for this transaction to be carried out. This transaction here to be carried out. So this transaction that is here is what we call transactional liquidity. And the liquidity here is what we call transactional. Liquidity on this top is what we call transactional liquidity. Because this liquidity that was taken is responsible for this correction to happen. Any correction that happens in the market, the liquidity rate responsible for that correction to happen is your transactional liquidity. Then inducement liquidity. Inducement liquidity is always sitting on your lower highs and on your higher lows. And in this scenario, we are what? We are in uptrend. We are in uptrend here. We are in an uptrend. That's why I say the trend is very important. So since we understand that we are in an uptrend here, every higher low you get in the market, every new higher low you get in the market is your inducement liquidity. So I said price comes from here. Let's say price start from here. Price is currently here. It went up, it went down. We have a lower high. Then we have another push to the upside. The liquidity taken here is what we call what? Your transactional liquidity. Why the liquidity sitting on this low, which is your previous low. This is your previous low. Don't get it wrong. The liquidity sitting here is now your what? Inducement liquidity. So this is your inducement liquidity. Liquidity sitting on this low. It is always sitting on your low, inducement liquidity, not on your high. What is sitting on your high is transactional liquidity. The liquidity sitting on your low, as long as you can identify your low, the liquidity sitting on your previous low is your what? Inducement liquidity. The only time you confuse inducement liquidity for transactional liquidity is if you don't understand your trends, or you don't know if you are on a lower high or higher low. And even in that case, you can also understand that there is a liquidity sitting on every high and every low. So if I am currently here now and I don't know the liquidity sitting here, I have to be able to put into consideration that there is a liquidity here, and price has to come and take that liquidity before it delivers. So even if I don't know the liquidity that is sitting here, I should understand that yes, there's a liquidity here, and treat it the way you treat other liquidity, like the transactional, the structural, and you have to treat that liquidity as the way, as long as you know that this is either transactional or structural. And the only time you can treat this as either transactional or structural or inducement liquidity without you being aware of what type of liquidity is here is only when you don't know the trends. Maybe market is reversing and you don't know. Maybe you have a POI here, you have a higher time frame POI here. If you have a higher time frame POI and it's reversing the market from an uptrend to downtrend, so this can now be your transactional liquidity. That is only when you know that this is a downtrend. But on an uptrend scenario, as long as market is in uptrend, the last previous low is your what? Inducement liquidity. And when this inducement liquidity is taken, you are expecting a what? An expansion to the upside. That is the difference between transactional and inducement liquidity. So transactional liquidity is here, taking price as a correction, while inducement liquidity is taking price as an expansion. So
Thank you so much. Well understood. Thank you so much. Well understood.
yeah, welcome. So we said in every push as of this, there is also transactional liquidity there. Okay, so now if you notice when we did internal and external structure, almost all the time frame, in fact almost all the time price, almost at the time price takes inducement, it gives almost a longer push. It always gives a longer push whenever price takes inducement. So when price takes inducement, it tends to expand more than the structural push. That is why the liquidity for the inducement liquidity is for expansion. Whenever you see any expansion in the market, that liquidity that is taking is liquidity, inducement liquidity. And the reason for this is when we talk about the supermarket scenario. I said something. I said if an item costs like £100, you pay £100 for the item. And if an item actually costs like £100 and you pay £100 for the items, so let me set up my mic. My mic is not connecting properly. Okay, we mentioned them when you pay. Okay, an item costs £100, and you pay £100 for that item. You will get one item, right? How many items will you get? You get one, right? Definitely. So, what if you want 3 items? So, how much do you pay? You pay £300. You pay £300 to get 3 items. So, you are creating more value, more liquidity. Hence, you need to get more items, more value. So, the more value you get, you pay more value for it. So the more you put value on the market, the more liquidity you get. You need to understand price is also factor. Price is factor in nature. You need to understand that the value of liquidity on higher time frame is higher than the value of liquidity on lower time frame. If you have a liquidity gap on this area, the kind of expansion, the liquidity you are going to have will be bigger than you having a liquidity gap on this area, on your structure. Let me see on structural liquidity. Yeah. So that's why the bigger the value, the bigger the transaction. If you have higher time frame liquidity gap, definitely you are likely to have a big push in the market. That's why the trading plan states that you should know where you are in the higher time frame liquidity cycle. Because once you can tell where you are in the higher time frame liquidity cycle, it means the next target for that time frame is going to be a major push. Right? If I'm currently here and price come here and take this liquidity, and I'm able to understand that this is my structural liquidity on 4-hour time frame, there is going to be a massive big push to the upside. That means I have a lot of push to be able to make money from. I know the next place my transaction is going to, the market is going to, is the next what? Transactional liquidity here. It's going to this next liquidity in this area. And because this is a 4-hour time frame. So in a major push, you can easily enjoy directional bias on the lower time frame to drive into the higher time frame liquidity level. So let's say this is a 4-hour structural liquidity that is taken here. On this lower time frame, market won't just deliver straight like this. It's going to give you another form of liquidities. It can give you structural liquidity, it can give you different type of liquidity here to drive you into this new and this higher time frame liquidity here. So you can have different form of setup here. You can have setup as this here. Another structural liquidity here that will be taken here, then drive you to here. Here you can have different inducement liquidity here, taking you here. You can have different form of liquidity that is going to take you here. So, but eventually you are understanding that if a higher time frame liquidity is taken, then we are expecting market to push to the higher time frame liquidity level. So if you wait patiently for your setup daily, you are going to enjoy a lot of trading when you trade with liquidity cycle. So I guarantee you, you find at least 1 or 2 good setup daily that will give you 10 to 15% cumulatively, and you'll be able to be fine with your trading time. So we are going to do we are going to have a trading plan session where we put in all this stuff into practice. Because I don't want you to wait for the end of the course or the end of the class before you start trading. You need to go to the market and start identifying these level starts, because if you wait for the end, you might get confused. There might be a lot of information for you to put into practice. So we are going to still go into the market to see how this stuff are being put together. But I'm going to chip in a trading plan where we can start practicing with a trading plan. So currently, because we'll be working with what we call time frame liquidity cycle. When you work with liquidity cycle, that is how the market delivers from one liquidity point to another liquidity point. But we won't be talking about that today. What we are focusing on is how to identify your liquidity area properly. Okay. But you still need to understand that what delivers this market from one point to the other is what? Is your liquidity. So we focus on inducement liquidity today. We talked about other liquidity last session. So inducement liquidity, is we measure fake BOS inducement. Fake BOS inducement. Fake BOS inducement. So you don't understand liquidity, your fake BOS. You don't know your fake BOS until you have a inducement taken. That is when you know your fake BOS. So we are not trading, we are no longer trading the regular break of structure trading, because break of structure trading keep us stuck to what? POI trading. And we have left that aspect a long time ago. So we are trading the proper way, the SLP, how market delivers, how the algo work actually. So when you have a break of structure at the current level, if you have a break of structure at this current level here, you can say this is a break of structure. You can't classify this as fake BOS until the inducement of this level has been taken. So when the inducement is taken, you now classify this as for fake BOS, fake boss inducement. Then this is inducement. Fake BOS inducement. So you always wait for the what? The inducement to be taken before you classify it as a fake BOS inducement.
Hello, sir. Can we consider fake BOS? Hello, sir.
Yes, I can get you.
Can we consider fake BOS without an unmitigated POI?
Yes, of course. Yes, you said can you consider a fake BOS?
Yeah, when fake BOS happen, can we see if we don't have a valid POI, is it valid? Can it state that that's still a fake BOS? When there is no valid POI below or above it.
Okay, so if I get you sorry. So if I get you correctly, the way fake BOS work, for instance, you have something like this now. Look at this trade here. You have a push to the oh my god. You have a push to the upside.
Yes.
A push to the downside, then a push to the upside again.
Yes.
Then a push to the downside, then a push to the upside again.
Okay.
So this is immediately price come to take this inducement here. I classify this place as a fake BOS inducement.
Okay.
So as long as price does not take this low, I don't see this as a fake BOS
Okay.
But what I need for market to deliver is what? Fake BOS inducement. This must happen, this structure must happen before I can do anything in the market, before I can take decision. Because remember, liquidity for expansion is our inducement liquidity. So we want inducement to be taken before we get into our trade. And this concept here you are seeing is concept of fake BOS inducement is what you're using as your MSU. If you understand your MSU, so that means we still need to watch the previous video. Okay, the videos there will be uploaded. Most of the video will be uploaded this new week. So you need to understand the concept of your. So let me show you one more. So here now we say we have a fake BOS. This is a push to the high upside. We say this is a fake BOS, then this is inducement. Yeah. Inducement taking on this low. So we don't know if this is fake BOS until inducement is taken. It's the inducement we are interested in to give us this expansion to the upside. And this is how market delivers in all way. Fake BOS, inducement, continuation. Fake BOS, inducement, continuation. Fake BOS, inducement, continuation. Fake BOS, inducement, continuation. That is what market delivers in every scenario. You're having your fake BOS, you have your fake BOS, inducement, continuation. You have your fake BOS, inducement. This is fake BOS, inducement. And now we're having a continuation to the downside. So this is how the market delivers in all aspects. So we are trading inducement liquidity. So this is just inducement liquidity. But for your inducement liquidity, so if you understand your inducement liquidity, go ahead in the market and look for your fake BOS inducement. And that is how you understand, get a very, very clear structure of your inducement liquidity.
Okay, so sorry, sir. So basically, fake BS is also inducement on its own.
Fake BS, yes.
An inducement on its own.
Yes, it's an inducement on its own, which is your transactional liquidity. Yes.
Okay.
Exactly.
Okay.
It's your inducement. Just depends on how you're treating it. But what it means is what it means is when you have the fake BOS, when you have that inducement, there have to be a fake BOS. A fake BOS. That is when you identify that fake BOS. When price just take a normal high, like a transactional liquidity, just take the liquidity. When price just take any liquidity and push down. If price just take this liquidity here, we can't classify this as a fake BOS until it comes to take this inducement liquidity. Because this is a downtrend. So price take this liquidity here. Of course, there's a liquidity here. But we don't know, we don't classify it as fake BOS yet until price take this. Immediately price take this, we now classify this as our fake BOS. So this is also, you can call this as your transactional liquidity, whatsoever. But remember, so when we are now putting everything into together, that is when you cannot trade from here. You can take a buy trade, you can get a trade from here. You can catch a trade to buy to this inducement liquidity, even before it happens. And when it now happens, you now know that this is your fake BOS and this is your what? Inducement. You can now still take a sell here. And that is where what we call liquidity cycle. So when you are buying, you can buy from this transactional liquidity to this inducement liquidity, from this inducement liquidity to the next transactional liquidity, from next transactional liquidity to the next EPA liquidity, EPA, or the next transactional liquidity. So this is how market delivers. So even if market takes this low here, it is a transactional liquidity, but we don't know that it's a fake BOS yet until the inducement liquidity has been taken. So whenever inducement liquidity is taken, there is always a fake BOS responsible for that inducement liquidity to be taken. So this is also a transactional liquidity, and this is there's a liquidity here, just as you mentioned. Of course, there's a liquidity, which is your transactional liquidity. So you can see it here. So even when the transactional liquidity is taken again, you have a what? A fake BOS. This is another fake BOS inducement. Inducement here. Price came to take the inducement. So until this inducement is taken, that is when you call this a fake BOS. Then it delivers to the downside. So the liquidity taken here, you might not be able to see it very well on 4 or 15 minutes. You might not be able to see the liquidity very well. So which means you need to go to lower time frame, such as 5 minutes, to be able to see the liquidity that is in this place very, very well. So the liquidity there now, so if you go to lower time frame, you can now see that this liquidity is actually transactional liquidity, or whatever liquidity that you can see there. But you need to go to lower time frame to be able to identify that if you can't see it clearly on your higher time frame. So this 5 minutes now. So the liquidity here is what? Is your transactional liquidity. So your fake BOS is actually your transactional liquidity in this regard. So did we get that? So you have your fake BOS inducements. Inducements is taken, then you have continuation to the upside. Fake BOS inducements, you have continuation to the downside. Fake BOS inducements, you have continuation to the downside. So are we clear? Do we have any other question? Or we can end the session and continue.
There's a question, sir.
Okay, go ahead, please.
What if in a series of higher high, there is no EPA? There is still some gaps that need to be filled. Then in a higher high, we now see a fake BOS. Yet the ones down, EPA is still open, down there. Can we still consider that fake BOS as being valid, as being tradable or not?
Okay, when we mention one of the class, we say, can you buy is different from will you buy. Can you buy? So can you buy is equals to EPA. Then will you buy equals to MSU. So this is the question you ask yourself whenever you want to trade. In our last class, we talked about where, how, what, and how, which I'm going to repeat in our next class.